All right, class, let's settle in. Today, we are diving deep into one of the absolute cornerstones of Canadian taxation and personal finance, the Registered Retirement Savings Plan, or as you know it, the RRSP. Getting a solid grip on how this works is non-negotiable, not just for passing this course, but for anyone serious about building wealth in this country. So, let's get started. Just a quick note before we dive in, this lecture material was prepared by Dr. Samir Al-Rashani, with some help from AI to get our sessions structured just right. Okay, so here's our game plan. We'll start with the absolute basics, what an RSP even is. Then we'll get into the why, the two massive benefits. After that, we'll hit the technical stuff, how to calculate your limits, what earned income actually means, and then some strategy on how to invest inside one. We'll wrap up with the rules you can't break and the penalties for when you do. All right, first things first, Section 1. What is an RSSB? Let's build a solid foundation because everything else we talk about today rests on this simple concept. So here's the textbook definition, but I want you to really focus on a few keywords here. Private, initiated, and controlled by the individual. This is crucial. This is not some government handout, and it's not something your boss manages for you. It's a powerful savings tool that you and only you control. You are in the driver's seat. Now, a really common point of confusion, one I see on exams all the time, is mixing up the RRSP with an RPP, a registered pension plan. Think of it this way. The RPP is the employer's plan. They set it up, they control it. The RRSP is your plan. It's personal. You might have both using your RSP to supplement your company pension, but never forget who's in charge of which. Okay, on to Section 2. So, why do we even bother with these things? What makes the RSP such a big deal in the financial world? Well, it really boils down to two huge, powerful benefits that work together to literally supercharge your savings. Benefit number one is the immediate win. You put money into an RSP, and you get to deduct that amount from your income. Plain and simple, it means you pay less tax this year. That's a great feeling. But the real magic, the long-term powerhouse, is benefit number two. Your money grows completely tax-free inside the account. No tax on interest, no tax on dividends, no tax on capital gains year after year. That is the secret sauce to building serious wealth over time. Let's put some real numbers to this, because this is where the light bulb really goes on. Imagine you have $6,000 to invest. Inside an RSP, that entire $6,000 goes to work for you. A 10% return? That's $600. Great. Now look at what happens outside an RSP. Before you can even invest that money, the taxman takes his cut. Assuming a 45% tax rate, you're left with just $3,300. A 10% return on that is only $330. And then you have to pay tax on that return. The difference is staggering. This is the raw power of investing with pre-tax dollars. Okay, grab your calculators, folks. We're moving into the nitty-gritty. Section 3 is all about figuring out how much you're actually allowed to put into an RRSP. You can't just dump in as much as you want. There are very specific rules. Let's walk through this example nice and slow. Your 2025 limit is based on what you earned in 2024. So let's say you earned $60,000. The starting point is 18% of that, which comes out to $10,800. But wait, let's say you also have a pension at work, and its value for the year was $6,600. The government basically says, hey, you're already getting a tax-sheltered benefit over there, so they subtract that amount from your potential RRSP room. That leaves you with a final contribution limit of $4,200 for 2025. That number we just subtracted, the $6,600, it has an official name, the Pension Adjustment, or PA. You'll see this number in a specific box on your T4 slip from your employer every year. Its entire purpose is to level the playing field, making sure that people with generous workplace pensions don't get an unfair double dip on retirement tax shelters. So if we put all of that together, this table gives you the master formula. This is what you need to know for the exam and for life. You start with any unused room you've carried forward, then you add your new room for the year, which is either 18% of your previous year's income or the annual max, whichever is lower. Then you subtract that pesky pension adjustment. What's left is your magic number, your maximum contribution for the year. Okay, let's move on. We keep throwing around this term earned income. But what does the Income Tax Act actually consider to be earned income? It's a very precise definition, and it's important you know what's in and what's out.
For the most part, it's what you'd expect: your salary from your job, the net income from a business you run, net rental income from a property you own. It can also include things like royalties or spousal support you receive. Basically, think of it as money you generated through active work or effort.
Now, here's the kicker, and this trips people up all the time, so listen close. Passive investment income, the interest you get from a savings account, dividends from stocks, capital gains when you sell an investment, does not count as earned income for this purpose. Just because your investment portfolio had a great year doesn't mean you get to contribute more to your RSSP. That's a critical distinction. All right, we've hammered out the rules of getting money into the RRSP. Now for the fun part, strategy. Once the money is in there, what should you actually buy to get the biggest tax-saving bang for your buck? This all comes down to a strategy called asset location. Think of your RSSP as a special greenhouse that protects your most sensitive plants from the harsh weather of taxes. So what are your most sensitive investments? Anything that produces interest income, like bonds or GICs, because that income is 100% taxable. You want to stick those in the greenhouse. On the other hand, things like Canadian stocks that produce capital gains are hardier. They already get preferential tax treatment outside, where only 50% of the gain is taxed. Putting them inside the RSSP is a waste of its protective power. This quote from our source material really hits the nail on the head. When you shelter a capital gain inside an RRSP, you're taking something that was only 50% taxable and turning it into something that will be 100% taxable when you withdraw it as retirement income. You are literally converting a tax break into a bigger tax bill down the road. It's a classic strategic blunder. Okay, last section, and it's a very important one. Let's talk about what happens when you get it wrong. The Canada Revenue Agency gives you these amazing benefits, but believe me, they do not like it when you break the rules, especially when it comes to over-contributing. Now, the CRA does give you a tiny little safety net. You have a lifetime buffer of $2,000. That means you can over-contribute by up to $2,000 in total without getting hit with an immediate penalty. Think of it as a cushion for an honest math mistake. But, and this is a big but, you can't deduct that $2,000. It just sits there until you earn enough new contribution room to absorb it. And if you go over that $2,000 buffer, ouch. The penalty is severe. It's 1% per month on the excess amount. That's not an annual rate, it's monthly. It adds up to a brutal 12% annual penalty, which will absolutely crush any investment returns you might be hoping for. This is a trap you want to avoid at all costs. So there you have it, the what, the why, and the how of the RSP. And listen, I know we're in a taxation course, and your mind is on the final exam, but this material, this goes way beyond the classroom. This is a practical toolkit for your entire financial life. So the real question isn't whether this will be on the test. The real question is, now that you know this, what are you going to do with it? That's the ultimate test.